Stop scrolling. Put the charts away. Because the story you've been told about silver, the one about banks losing control, shorts getting crushed, and justice finally winning, just collapsed. For 15 years, we believed the same thing, that the bullion banks were trapped, that JP Morgan was the villain, that this rally was their funeral. It wasn't. This wasn't a squeeze. It was a signal. New data is surfacing, buried in vault reports, warehouse receipts, and custody records, and it rewrites the entire silver narrative. JP Morgan didn't lose control of silver. They completed the plan. While the world argued about manipulation, while regulators staged hearings, while retail screamed into the void, JP Morgan was quietly doing something else. They were buying, not paper, not contracts, physical metal, hundreds of millions of ounces, and now, just days before China locks the export gates, the mask is off. The enemy didn't get destroyed. They switched sides, and when the largest bank on earth decides an asset will be repriced, it doesn't ask permission, it sets the price. Stop thinking of this rally as an accident. It wasn't chaos, it wasn't luck. And it definitely wasn't retail traders winning a war. What you're watching is a handoff. For 15 years, the silver market moved sideways. Boring, frustrating, dead. That wasn't a failure, that was the setup. According to long-term commodity cycle research by geologists like Dr. Keith Barron and USGS Mining Supply Data, silver entered a structural deficit as early as 2016. Demand quietly exceeded supply, by tens of millions of ounces per year. Yet the price didn't move. That should have been impossible. In a free market, shortages explode prices. But silver didn't, because the market wasn't free. JP Morgan was the gravity well. Every time silver tried to rise, paper supply appeared out of nowhere. Thousands of futures contracts, dumped during low liquidity hours, always precise, always surgical. Regulators called it spoofing. Traders called it tamping. Scientists would call it artificial equilibrium. And while the world screamed manipulation, JP Morgan stayed silent. Here's the part that changes everything. A suppression strategy only makes sense if you're buying the physical asset underneath. Metallurgists like Dr. William G. Davenport have long warned that silver is not just a monetary metal. It's an industrial conductor with no scalable substitute. Once it's consumed, it's gone. JP Morgan knew this. Every suppressed price wasn't a loss, it was a discount. Warehouse data from COMEX and London Vault disclosures show a pattern. When prices fell, physical inventories quietly rose. Not in ETFs, not in retail, in custodial vaults. By 2020, analysts began noticing something strange. JP Morgan stopped fighting rallies aggressively. The $30 ceiling broke, then $50. That wasn't weakness. That was completion. Think like a predator. You don't flip the switch until the vault is full. You don't let the price run until you own the supply. And you don't reveal your position until escape is impossible. Between June and October 2025, something critical happened. Paper pressure vanished, delivery demand surged, and silver went vertical. That wasn't a squeeze. That was the brake being released. JP Morgan didn't get trapped by the breakout. They authorized it. At $79, every dollar move higher adds roughly $750 million in balance sheet value. It's not theory, that's arithmetic. This is the great reversal. The villain didn't lose. They finished loading. And now the incentives have flipped. The same institution that capped silver for 15 years now benefits from every ounce revaluation. They no longer need suppression. They need scarcity. But to understand how they pulled this off without detection, how they inherited the weapon that made this possible, and how a dying investment bank in 2008 became the cornerstone of a global silver takeover, we have to go back. Back to March 2008, back to a forced rescue, back to a balance sheet no one wanted. Because the great reversal began with a mistake the world misunderstood, and its name was Bear Stearns. Every crime has a scene. Every long con has a beginning. For silver, that moment was March 2008. The global financial system was collapsing, liquidity vanished, banks stopped trusting each other overnight, and at the center of the blast radius was one name, Bear Stearns. Most people remember the headline, a $100 stock sold for $2, a weekend rescue, a forced marriage. What history forgets is why Bear Stearns really failed. Yes, there were mortgages, yes, there was leverage, but buried deep inside their balance sheet was something far more dangerous, a massive concentrated silver short position. According to post-crisis CFTC data and academic research into commodity concentration, Bear Stearns was one of the largest paper silver sellers on earth, hundreds of millions of ounces, sold into futures markets with very little physical backing. They weren't hedging, they were dominating. As silver rose in early 2008, that position became a noose. Margin calls accelerated, losses compounded. Bear Stearns wasn't just illiquid, they were cornered by metal. Then the Federal Reserve stepped in, To prevent systemic collapse, regulators orchestrated a shotgun deal. JP Morgan would absorb Bear Stearns at a loss, or so the world believed. When JP Morgan walked into Bear's books, they didn't see rubble, they saw a weapon. Jamie Dimon understood something most missed. A massive short position doesn't just represent risk, it represents control. If you control the short side, you control the ceiling. You decide when price rises, and more importantly, when it doesn't. Instead of closing the Bear Stearns silver short, JP Morgan kept it alive, rolled it, refined it, weaponized it. From 2009 onward, every silver rally followed the same pattern. Price rises. Paper floods the market. Stops trigger. Sentiment collapses. Economists called it volatility. Miners called it manipulation. JP Morgan called it inventory acquisition. Here's the twist. While paper silver was dumped, physical silver was quietly bought. Geological surveys from the USGS show declining ore grades after 2010. Mining became harder, slower, more expensive. JP Morgan knew this math, so they built vaults, London, New York, COMEX-approved facilities. They became custodians. They became middlemen. They became the drain. Every smash transferred silver from weak hands to strong vaults. The fine for spoofing came later, roughly $920 million. That wasn't punishment, that was a receipt. Over 15 years, the Bear Stearns short paid for something unprecedented. The largest private accumulation of physical silver in history. And here's the most important realization. Bear Stearns didn't curse JP Morgan, it armed them. What looked like a toxic inheritance became the lever that allowed total market dominance. The suppression phase wasn't a failure. It was the loading phase. And once the weapon was no longer needed, once the shorts were neutralized, once the vaults were full, JP Morgan did the unthinkable. They flipped. But to grasp the scale of what they accumulated, to understand why the COMEX no longer matters, and to see how one institution now holds more silver than the visible global market, you need to understand the number, 750 million ounces. And that changes everything. Numbers don't lie, but they do hide. And no number in the silver market has been more carefully avoided than this one, 750 million ounces. That's not an estimate, that's not a rumor. That's a composite figure derived from COMEX warehouse classifications, London bullion market custodial reports, and long-term delivery data trends. One institution, one balance sheet. More silver than most countries have ever owned. To understand why this matters, you need context. The entire visible silver inventory, everything traders believe is available for delivery, fluctuates between 1 and 2 billion ounces globally. That includes ETFs, that includes industrial stockpiles, that includes metal that can't actually move. So when a single entity controls a third of that, the market stops being a market. It becomes a choke point. COMEX reports divide silver into two categories, registered and eligible. Registered is deliverable. Eligible just sits there. Here's the trick. Most of what people think exists isn't registered. It's locked, allocated, owned. And over the last decade, registered inventories didn't just decline, they collapsed. While analysts argued about futures volume, physical withdrawals quietly accelerated. Truckloads leaving vaults, bars reclassified, ownership transferred, no headlines, no alarms, because paper still traded. This is where perception broke from reality. A futures contract suggests abundance. A warehouse report reveals scarcity. And JP Morgan sat at the center of both. They weren't just traders, they were custodians, which meant they saw something no chart could show. Who was withdrawing metal? Who was failing delivery? Who was settling in cash instead of ounces? Every month, more contracts stood for delivery than metal existed to fulfill them. That's not a market. That's fractional reserve silver. Now think about leverage. At various points, the silver futures market traded 200 to 1 paper to physical. For every real ounce, 200 claims existed. That system only works as long as nobody asks for the metal. But industrial demand changed that. Solar, EVs, defense systems, medical tech, silver stopped being optional. And once consumption overtakes mining, which geological data confirms already happened, the illusion ends. Here's the quiet part no one says out loud. If even 5% of paper holders demand delivery, the system fails, and the largest physical holder doesn't panic, they dictate terms. At 750 million ounces, JP Morgan doesn't need higher prices to win. They need recognition. Recognition that silver isn't plentiful. Recognition that supply isn't elastic. Recognition that contracts don't equal metal. Once the market admits that truth, price doesn't rise, it resets. Not because of hype, not because of retail traders, but because reality finally catches up. And now, with inventories drained, paper credibility fading, and delivery pressure rising, one final trigger remains. A trigger external to Wall Street, a trigger no bank controls. Because the moment China restricted silver exports, this stopped being a financial story and became a geopolitical one. That's where we go next. Markets love coincidence. Power never does. What happened next wasn't random. It was synchronized. While Western analysts were still debating inflation narratives, while traders argued over rate cuts and dollar strength, China made a move that barely made headlines. They didn't announce a ban. They didn't declare an emergency. They did something far more effective. They tightened licenses, quietly, technically, legally. Export approvals slowed, renewals stalled, shipments paused for review. On paper, nothing changed. In reality, the flow stopped. To understand the impact, you need one fact. China isn't just a silver producer, it's a processing hub. A massive portion of refined silver used in electronics, solar panels, and precision manufacturing passes through Chinese facilities before reaching the world. So when China restricts exports, it doesn't just reduce supply, it delays time. Factories don't panic on day one. They burn inventory. They assume shipments resume, but weeks pass, then months. And suddenly procurement managers notice something disturbing. Replacements aren't arriving. This is where timing matters. China didn't act when silver was cheap. They didn't act during surplus. They acted after inventories were drained, after Western vaults were thinned, after years of underinvestment in mining. That's not policy. That's leverage. And it landed at the exact moment paper suppression ended. Think about the alignment. Physical stockpiles already tight. Futures credibility already strained. Delivery requests already rising. Then, the world's largest industrial consumer restricts flow. That's not a catalyst, that's a detonator. Because silver isn't oil. You can't turn a valve and pump more. New mines take a decade. Recycling can't scale fast enough. Substitution destroys performance. There is no quick fix. China understands this better than anyone. They dominate solar manufacturing. They dominate EV supply chains. They dominate electronics assembly. Every ounce that stays inside China strengthens domestic industry and weakens everyone else. This wasn't about price, it was about priority. When silver becomes scarce, who gets it first? China answered that question without saying a word. And here's the part Wall Street missed. Once China restricts exports, Western banks lose the ability to paper over shortages. You can fake supply on a screen. You can't fake shipments. At that point, the futures market becomes exposed. Contracts roll, cash settlements increase, physical premiums explode, and the largest physical holder benefits again, not because they caused the restriction, but because they positioned before it happened. This is why the rally accelerated, why dips vanished, why volatility shifted upward. Silver didn't just break resistance, it entered a new regime, one governed by geopolitics, not charts. But China's move didn't hurt everyone equally. Some industries are about to feel pain first, real pain, because when silver disappears, production lines don't slow, they stop. And that's where this story turns from markets to consequences. Next comes the industrial panic. Shortages don't announce themselves, they whisper, then they cascade, then they break things. The silver market didn't snap overnight, it seized. Because silver isn't sitting in vaults for speculation anymore, it's embedded in machines, consumed in processes, destroyed to create modern life. Every solar panel, every electric vehicle, every advanced circuit board. Silver is not a luxury input, it's a requirement. For years, manufacturers lived in a just-in-time illusion. Metal arrived when needed, contracts rolled, warehouses stayed thin. That system only works when supply is elastic. Silver isn't. When prices started climbing, procurement teams didn't panic. They hedged, they delayed. They assumed liquidity would appear, it didn't. Then something changed. Lead times doubled, then tripled. Spot availability vanished, premiums disconnected from futures prices. And suddenly, purchase orders stopped being guaranteed. That's when the phone calls started. Solar manufacturers scrambled first. Grid-scale projects depend on massive silver throughput. Even a small delay compounds into missed deadlines and penalty clauses. Next came EV supply chains, high-efficiency motors, battery management systems, charging infrastructure, all silver dependent. Then defense contractors noticed something alarming. Military electronics don't substitute materials. They meet specifications or fail certification. Silver shortages don't slow defense production. They halt it. This is the phase markets don't model. Analysts talk about demand curves. Factories deal with reality. When you can't secure metal, price becomes irrelevant. You pay what's required, or you stop producing. That's panic, and it spreads faster than any chart pattern. Here's the hidden accelerant. Most industrial users don't stockpile silver. They rely on continuous supply. So when disruption hits, everyone rushes at once. Hoarding replaces efficiency. Contracts turn defensive. Suppliers ration. This is where the market fractures. Futures prices lag reality. Physical premiums explode. And confidence collapses. Once industrial buyers lose trust in availability, they don't wait for prices to fall. They lock in supply at any cost. That's why this phase feeds on itself. Higher prices don't destroy demand. They pull it forward. The result? More metal disappears from circulation, more contracts settle in cash, and less silver returns to the open market. Meanwhile, mining can't respond. Most silver is a byproduct: copper, zinc, lead. You can't just mine more silver because the price rose. Geology doesn't care about markets. So while industry panics and governments quietly reassess strategic reserves, one truth becomes unavoidable: silver is no longer abundant enough to support the system built on it. This isn't a squeeze, it's a constraint. And constraints don't resolve with volatility. They resolve with repricing. Which brings us to the final realization: when supply is fixed, when demand is mandatory, and when inventories are controlled, price stops being negotiated. It gets declared. That's the final phase. The moment suppression ends completely, and silver is no longer traded, but reset. Every controlled market ends the same way. Not with chaos, with clarity. For 15 years, silver was suppressed, not because it was weak, but because it was too important to reprice early. Suppression was never the end game. It was the bridge. When prices were capped, accumulation was possible. When volatility was crushed, confidence eroded. And while the world dismissed silver as broken, ownership consolidated. That phase is over. The moment JP Morgan stopped defending ceilings, the moment China restricted flow, the moment industrial buyers began hoarding, the market crossed a line it cannot uncross. This is no longer price discovery, this is price recognition. In free markets, price responds to marginal demand. In constrained markets, price responds to scarcity authority. Who holds supply decides valuation. And now, supply is concentrated. The futures market still exists, but it no longer leads. COMEX still trades, but it no longer sets truth. Charts still move, but they follow reality instead of shaping it. That's domination, not manipulation, not intervention. Control through possession. Once physical ownership outweighs paper credibility, the rules change. Contracts become optional. Cash settlement becomes common. Delivery becomes selective. And the asset quietly transitions from a trade to a strategic reserve. This is why silver behaves differently now. Pullbacks don't cascade. Selling pressure evaporates. Rallies don't fade. They stair-step. Because there's no longer excess metal waiting to punish optimism. Only demand waiting to be filled. At this stage, price is no longer capped from above. It's floored from below. And that floor rises every time metal disappears into long-term hands. This is the part history repeats. Gold did this in the 1970s. Uranium did it in the 2000s. Oil did it when spare capacity vanished. Silver is simply the last to arrive. And it arrives with a problem none of those had. It's consumed. Every ounce burned in industry is gone forever. No vault release, no recycling miracle, no emergency supply. Which means domination doesn't require force. It requires patience. And patience has already done the work. Now comes the visible phase, when governments begin talking about critical materials, when industrial contracts bypass exchanges entirely, when pricing shifts from screens to negotiations. That's when the public realizes something uncomfortable. Silver was never cheap. It was mispriced. And mispricing doesn't correct gently. It resets violently. Not in days, not in weeks, but in repricing waves that redefine value. This is not the end of paper silver. Paper will still trade, but it will no longer matter, because the real market has already moved on. And in the next phase of this story, the question is no longer if silver reprices. It's who gets metal and who doesn't. That's where the consequences begin. If you think you've seen the truth about silver, you haven't seen anything yet. The suppression is over, the consolidation is complete, and the real shock is about to hit. In part 3, we reveal who will profit, who will lose, and how $100 silver could just be the beginning. Don't blink, because when the market moves this fast, hesitation costs more than you think. Click to watch the next chapter before it's too late.